To understand where markets are moving structurally, we have to start at the highest level of the U.S. macroeconomy. On August 7th, the Bureau of Labor Statistics reported that U.S. non-farm payrolls shed 23,000 jobs in July. This chart shows the gap between the reporting and the market's expectation. Against a forecast of 80,000 jobs added, the loss represents a total miss of 103,000. Government and retail trade led those losses, while total labor force participation slipped to 61.4%. Relying entirely on broad consensus forecasts can leave investors unprepared when sudden economic contractions actually materialize. Moving from the broader economy down to the regulatory level, we see a similar dynamic in how the private funds market is supervised. On August 10th, the Securities and Exchange Commission charged private fund advisor Added Ventures Management in an alleged $70 million fraud. This flowchart illustrates the allegations laid out in the filed complaint. The SEC states the firm bought shares in SpaceX and Klarna, inflated the price, and then sold them into client accounts at that markup. The takeaway for investors is that regulatory protection here is reactive. The SEC does not pre-screen private fund advisors before they begin operating. That absence of upfront protection becomes even more pronounced in the digital asset space, where traditional financial safeguards often vanish entirely. On August 14th, CoinDesk reported that the Office of the Comptroller of the Currency granted World Liberty Trust Company a conditional national trust bank charter. The mandate is to issue the USD1 stablecoin and to custody digital assets for institutions, taking that role over from BitGo. Crucially, this charter carries no FDIC insurance. The standard $250,000 coverage limit that savers generally assume simply does not apply here. At the institutional level, positioning often happens quietly. CoinDesk reported that UBS multiplied its IBIT call positions roughly 24 times in a single quarter, growing from 80,000 to 1.95 million underlying shares. Because the filing was dated June 30th, that massive exposure had already compounded long before it became visible to the public. In opaque markets, everyday investors typically move slower than the institutions, and assuming standard protections exist is a costly mistake. Looking strictly at the mechanics of crypto yield, holding unstaked Ethereum earns nothing, while Ethereum staking pays about 3.8% a year. This graph illustrates that divergence. On a $100,000 holding at that rate, that is roughly $3,800 a year, or about $317 a month given up by not staking. At that same rate, $100,000 compounds to roughly $120,500 over 5 years. This gap exists in traditional vehicles as well. BlackRock filed on August 7th for a version of its Ethereum product carrying a 3.8% yield. The existing product passes no staking yield to holders at all, meaning that same roughly $3,800 a year per $100,000 is given up inside the ETF wrapper. Solana behaves the exact same way. Solana staking pays about 6.5% a year. On a $100,000 holding, at that rate, that is roughly $6,500 a year, or about $542 a month given up by not staking. Passive holding of digital assets, even when secured inside a regulated ETF wrapper, leaves mathematical compounding on the table. Zooming down to the everyday Canadian portfolio, we can see the literal cost of unoptimized daily cash. Canadian money market ETFs such as PSA yielded about 4.7% recently, fully sheltered inside a TFSA. This graphic contrasts that yield against a standard high-interest savings account, which pays roughly 3%. The gap between them is the point, about 1.7 percentage points. On a $95,000 TFSA balance at that gap, that is roughly $1,615 a year, or about $135 a month in missed return. Letting cash sit passively in a tax shelter is an active decision to lose purchasing power. The structures of Canadian retirement accounts force certain inevitabilities as they age. Conversion from an RRSP to a RIFE is mandatory in the year a Canadian turns 71. The published CRA minimum withdrawal factor at that age is 5.28%. On a $500,000 RIFE at that factor, that forces about $26,400 of taxable income every year, whether it is needed or not. This higher forced income can push a retiree into the range where old age security begins to be clawed back, depending on an individual's total net income against the annual threshold. This chart shows the reality of fixed-rate sheltered assets. A $50,000 GIC at 4.5% grows to roughly $77,600 over 10 years. That is the whole return. A GIC pays its stated rate and nothing more. The question worth asking is not whether that rate is good, but whether a tax shelter is the right place to hold an asset that cannot compound hard. That wraps up our market review for this week. Thank you for watching, and we will see you in the next recap.